Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is April 3rd. We are going to take a look at Intel. This is one that used to be in my portfolio. I sold out of here a little over a year ago. We're going to see if the numbers have gotten any better on this one. This is out of the information technology sector. You're probably well aware of Intel. They do chip manufacturing, IT related products. Let's jump right in. And if you are new to the channel or would just like to help me out, it doesn't cost you a thing, but it really does help out a small YouTube channel like me with the YouTube algorithm. Go ahead and hit that thumbs up button down below. Subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. And drop a comment down below. Is Intel in your portfolio? Is it one you're watching? Is it one you're avoiding? Is it one you're selling with the recent downturn? Let me know what you think in the comment section. Love to hear from you. Now, this is the vested interest stock screener. This is how I look at a company on a high level to see if it goes in the possibly to invest pile. It is also how I run through the stock pick of the day video. So we're going to run through this criteria here. And just because it meets 5 of 8 or 6 of 9 if it's a financial company doesn't mean you should blindly go out and buy it. I definitely do not. I do more of a deep dive into the financials and then come up with a price that I'm willing to pay for the company if I am interested. This is also how I look at companies already in my portfolio, and it's a back check to make sure they still meet my criteria and they have not gone off into right or left field, or that I may need to do some more investigating on what might be going wrong if they do not meet the criteria that I've set on this screener. Now back to Intel. If you want to know more about them, check them out at www.intel.com. That's www.intel.com. That is their homepage where I pulled this information from. Our purpose, we create world-changing technology that improves the life of every person on the planet. Intel put the silicon in Silicon Valley. For more than 50 years, Intel and our people have had a profound influence on the world, driving business and society forward by creating radical innovation that revolutionizes the way we live. Today, we are applying our reach, scale, and resources to enable our customers to capitalize more fully on the power of digital technology. Inspired by Moore's Law, we continuously work to advance the design and manufacturing of semiconductors to help address our customers' greatest challenges. And really, that's their bread and butter, right? They're a semiconductor manufacturer. They are building a lot of new manufacturing plants here in the United States, which I do like, as well as them and Taiwan Semiconductors and a few others. So I like that they're bringing manufacturing back stateside. And some of the other products, they offer processors, select system and devices. For your laptops, I think my business computer has the little sticker that says Intel inside, so that means some of their chips are inside that one. Accelerators, AI software solutions, right? They had to get that AI plug-in. That's the new buzzword. Network to edge, FPGAs, programmable devices, right? So anything around IT and tech, they're kind of in there. But again, their bread and butter are the processor chips. That's really their bread and butter. I believe as part of their new business plan, they are going to be doing some manufacturing for other chip manufacturers or chip companies as well. So they may have their hand in not only the chips that they manufacture, but also for other companies, which gives them a little bit more incoming revenue stream if they're doing that sort of manufacturing. Now, the reason we're taking a look at them, down 8.22% on the day, big drop on the day. We are talking about Intel Corporation, ticker INTC, out of the information technology sector. Closed out the day at $40.33. 52-week range as low as $26.85, as high as $51.28. Kudos to you if you were buying them back when they dropped in the $26 range or the $20 range. I think they're much more attractive down in that price range. I think they have run up significantly and need to pull back before I would be interested again, if I'm interested at all. Let's take a look at the numbers. Market cap of $170.515 billion. So they are a large cap company, a beta of 1. So they are right in line with the overall market. You can really see that volatility throughout the day, right? Just a pretty steady downturn overall. Earnings per share sitting at, PE ratio first. PE ratio extremely elevated, 100.83. That's extremely high, right? That even if they're growing fast, I don't think that I don't know that they're really growing as fast as a company like NVIDIA or some of the other big players that are out there now. A lot of competition in this space now. A lot of companies out there making chips. Though some of them are different types of chips, around gaming. I don't necessarily think Intel is in the gaming space. Again, they're more processors, processing units, but very elevated price earnings here. EPS at 40 cents. Earnings date April 25th, so coming up here at the end of the month. Forward dividend yield, very, very low. They cut their dividend here last year, I believe. We'll see that here in a little bit. And that is part of the reason I sold out of them. Not only were they having some issues, it was more of a turnaround play whenever I got into it, but they had said they were going to keep the dividend intact. And whenever they decided against that and cut the dividend shortly thereafter, I can't trust management whenever they tell you one thing and then within a quarter they turn around and do just the opposite. So that was a bit concerning to me, because if they're going to lie to you about that, what else are they going to lie to you about? So that was part of the reason I sold out of them. Ex-dividend date was February 6th. Looks like they paid out March 1st. So you would have just gotten, or last month here, March 1st, you would have gotten your dividend if you own this one. And if you buy them now, you would have to wait a couple more months before you get the next dividend. And 1 year target estimate, at least according to Yahoo Finance, $45.47. So they see some upside potential from where it currently sits. Now if you were to go over to Yahoo Finance, where I pulled this information from, not affiliated, just one of the sources that I go to, you could jump over here to the left-hand side. You'd see some, tabs that you could click on. One of them is statistics. So we're going to look at dividend yield theory. That's where you go, statistics. Then go down to dividends and splits. You look at their 5-year dividend yield average at 2.92%. You compare it to their forward dividend yield of 1.14%. And typically this is pretty reliable. This speaks to overvaluation. Now I will say this one might be a little bit impacted because of the dividend cut they recently had within the last year. So that's going to impact their 5-year average. Though I would say even looking at their trailing annual dividend yield of 1.68% compared to its current, they're still potentially overvalued. So I would say right now, this company needs to pull back. Payout ratio, very elevated. This is another reason I sold out of them. Their free cash flow is all over the place. Not good to see. 185% payout ratio. Anything over 100%, unless it's, a REIT that's required to pay over 90% of their payouts. Some limited partnerships pay over that. They're issuing some shares over time as part of their investment strategy and investment plan. So payout ratios on those type of companies do get elevated, but for a company like this, a payout ratio over 100 is not good. That means that they are going into debt or using some other ways, issuing shares, however they're doing it, to pay out the dividend continually. Now we're going to take a look at free cash flow. Again, if you were to go over to Yahoo Finance page, you go down to financials, and that's where you'd find free cash flow. You're going to find a lot of good information there. Their balance sheet, their income statement, their debt to equity ratios. Is their revenue growing over time? Are their margins increasing or decreasing? Are they paying down debt? A lot of good information there you should be checking out. For our purposes, we're going to look at free cash flow. We want growing free cash flow over time, because typically if you have growing dividends or growing free cash flow, you have growing dividends to go along with it. Going back to 2020, $20.9 billion in free cash flow. Very nice. 2020, well, this is where things start to get bad. 2021 down to $9.1 billion, so decrease. 2022 into negative 9.6, decrease. 2023 into negative 14. So just a steady decrease in free cash flow. Not good. Don't like it. Can't happen. Not sustainable at all. Now, stockanalysis.com is another site that I like. Now, you pick any sites that you want for information. Just make sure you're looking at more than one so you can get the information, make sure the information is accurate and up to date. That's why I look at more than one, 2, if not 3 sites, so you can verify the information you're getting is accurate. They have 27 analysts that have taken a look at this. They call it a consensus hold. I would agree. It's at a minimum a hold, if not a sell. I did sell out of the position. That doesn't mean you have to. Maybe you believe in them long term and you didn't mind that the company's CEO said he was going to keep the dividend and then cut it, but I was not happy with that. So at a minimum, I would agree with their assessment as a whole. They have a low estimate of $17. That's pretty low. I mean, it did get down into the high 20s. I don't know that it's ever going to drop down in the 17s, but it's possible. If they don't get their free cash flow in order in the next couple of years, there's a possibility it could really drop. Average estimate of $43, that would be a 6.57% increase, and it's pretty much in line with what we saw with Yahoo Finance on the previous page. High estimate of $66, that would be a 63.57% increase from where it currently sits. All the while, you could collect that small dividend that they are still paying. Now, return on equity and return on invested capital, you'll find under the statistics tab. I like 10% or better for these. Return on equity sitting at 1.7%, very low, too low for me. Return on invested capital, 0.13%. They are, again, using a lot of capital to reinvest back in and build plants and increase their manufacturing capability here stateside. So I like that, but it also comes at a cost to their return on invested capital. 0.13%, very low. So it's going to take them some years before they start to see a return on those investments. They've got to finish those plants, get those manufacturing lines up and going, and start selling those chips, right? So it's going to take a while. That's where the earnings, EPS, earnings per share, forecasted growth, and revenue growth comes into play. I like 5% or better for EPS growth. They are expected to grow very fast. They are really expecting some good turnaround from those plants that they're building out, 86.36%. So if that were to happen, that's very good to see. Great if they did. Maybe over the next couple of years we start to see some of that, and then it's more of a, instead of a turnaround play, it's more of a back to a growth play. We'll see. And they expect revenue growth in double digits, 10.68%. So those are good numbers. The other numbers are not really good. Free cash flow over 100, free cash flow decreasing, payout ratio over 100%, return on equity, return on invested capital too low for me, though these numbers are pretty good. So if you believe the forecasts and it was to dip low enough, maybe I think it needs to come back down into the high 20s, in my opinion. Too high for what the company is right now. You're really betting on the future on this one. A huge turnaround play. Let's look at the dividend history here. So again, over 100% payout ratio. They've got 125. Yahoo Finance at 185. Either way, it's over 100%. Not good. Dividend growth is in the negative. They recently cut their dividends. You'll see that. Buyback yield negative 2.16%. Shareholder yield negative 0.93%, right? So going back to 2021, you can see they were paying a 34-cent dividend. They did raise it here. Why they raised the dividend in 2022, I don't know. If they were just going to cut it the year later, that's pretty dumb in my opinion, but raised it up to 36 cents. And then May 2023, shortly after this is whenever I jumped out of the company, they dropped the dividend down to 12 cents. That's where it's remained ever since. And that was really the nail in the coffin, so to speak, for me. You know, here sometime in February, whenever they paid out this 36 cents, they came out and said, yeah, you know, we're not going to cut the dividend. Then they turned right around within the next quarter and did just that. So that's Intel. Let me know what you think. I think it needs to come back significantly, and even then, you're betting on a lot of future growth that may or may not arise. A lot of chip companies out there right now. They are not the only player in town anymore. Micron, you know, Nvidia, you know, several others now. But they could be poised for a turnaround. You know, you never know. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. If you have a company like Intel you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below, and I'll try to work into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and gains money, so never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice counsel of a certified financial advisor.